Joining us right now is Steve Eisman as the host of Real Eisman Playbook podcast, former senior portfolio manager at Neuberger, and of course, character in The Big Short. Do you like being described that way? I don't know.
I think it's going to be on my tombstone.
Okay, well, help us understand this. I think we're all trying to make sense of oil on one end of the universe looking very complicated, AI looking like a hockey stick, maybe.
Right.
And then some of the numbers that we just learned more recently that sort of makes a sort of bifurcated economy, and how you make sense of that.
I think what's fascinating is if you go back to March when the market was going down, you had a bunch of people who I deeply respect talking about regime change, that sell your index funds, buy oil, buy gold, sell tech. And that lasted for a couple of weeks. And at the end of March, I think the market was down 4%, NASDAQ was down 7%, and now the market's up 4 to 5, and the NASDAQ's up 7%.
Yep.
And the leaders are tech, the same leaders, tech, banks, energy's down, gold's doing nothing, Staples is doing nothing.
And is that real or is that a narrative?
I think, look, the story of the economy last year was AI spend, credit quality is fine, K-shaped economy. And the story this year is AI spend, credit quality is fine, K-shaped economy. We are literally back to where we were last year, the same exact narrative, unchanged. It's as if nothing happened in between.
And therefore you would do what?
Stick to what I own mostly, which is tech, some financials. I don't own any staples. I don't really own energy. I own the same stuff that I owned in the past.
You like financials?
I do. I like some financials. I don't like the alternatives, but I do like the traditional banks.
And you like tech, meaning just the Mag 7 or something broader than that?
I like most of the Mag, and then I like on the industrial side companies that are power related. So like GEV,
right.
Quanta, which is reported this morning, great numbers. That kind of Eaton.
But who would have thought that Caterpillar could connect? I mean, I don't think people said to themselves before, Caterpillar is basically an AI company or an AI powering company of sorts.
Well, it partially is because it's supplying stuff to build all these data centers.
So you like the S&P?
I do. I don't have a problem with the market right now.
That's amazing.
I really don't. You know, I got an email from a viewer who, and I'm going to answer it tomorrow on my wrap. But the viewer pointed out that, you know, by any traditional metrics, and he listed a couple of them, the market's expensive, and I think that's fair. But I think what people don't think about is 10 years ago, infotech was 18 to 20% of the S&P. And now it's 35% of the S&P. Then if you add in Google, Meta, which are not technically in infotech, it's really 50% of the S&P. So the market's more expensive because tech has become a much bigger percentage of the S&P. So I don't think the argument, and tech sells at higher multiples generally than everything else. So I don't think the argument that the market is per se expensive is compelling.
What do you make of the private credit story? So one of the things that people have been
talk about this every week.
So people have been wringing their hands about private credit.
Right.
We talk about it all the time.
Yep.
Some people think it's going off a cliff and is systemic and terrible. I'm not of that view, by the way. But,
I'm not either.
But others, I think there's problems in the private credit space.
Yes.
But the question is, does it matter?
I don't know how much of an impact it's going to have on the economy. Even if it creates a credit cycle, it's not systemic because the banks are better capitalized than they've probably ever been in their history. So I don't sense a systemic risk. I think the issue with private credit is it has overexposure to software. And you know, there was an interesting report yesterday from Ares. Ares put out this report saying that of its software exposure, 85% is fine, and only 15% is problematic. And when they say, and let's accept that as an honest report.
Okay.
The problem is that when you say 85% is fine, what you mean is that the companies are performing and they're paying their interest. That's not the issue. The issue is that take a company like ServiceNow, iconic software company. August of last year, it was at 209. It's now 88. It's down 60% from the peak. So if you're private, let's do private equity first. If you're private equity and you have overexposure to companies that you have bought of software, your companies are worth less than half. Period. There's no argument about it. So the issue with even these companies that are fine is when it's time to get them refinanced, right, who's going to want to lend to them when the equity is less than half? That's what's coming. It's not. I don't know how those companies are going to do. Nobody does. But without question, the equity value has been obliterated.
Is there anything you wouldn't touch right now? Or that you'd actually short, given your reputation?
Well, I'll say this openly. I'm short FICO.
Because?
I think that FICO very arrogantly has raised prices about 500% over the last many, many years, has ticked off literally everybody in the lending world. And even now, after they've cut prices, when you compare their price to what VantageScore is going to charge for mortgage, it basically works out to something like for every 100 mortgage applications, a lender will get charged by FICO $2,000, and at VantageScore, they'll get charged $99. $2,000, $99. There's a big difference between $2,000 and $99.